Hello, welcome back. So in today's video, I'll be talking about why I'm avoiding these undervalued stocks. So in today's video, I'll be covering a few things. We'll be covering why I'm avoiding these undervalued stocks, the biggest earnings this week, as well as some questions that you guys have left me in the comment section below. So the first undervalued stock that I'll be avoiding is none other than PayPal. So PayPal is a company trading at 15 times earnings, and year to date is down around 19%. It's up by quite a fair bit since its 52-week low already. I believe it was trading at around $55 just a few weeks ago. So up around 15% or so. So for PayPal, this is their latest earnings. They saw revenue growth of 1%. They saw total payment volume growth of 3%. And their transaction margin was 7% and free cash flow dropped by around 23%. So for PayPal, it is clearly a business that is slowing in terms of growth. So this is PayPal's revenue growth. The revenue growth has been slowing all these years. Over here, the revenue growth has been declining all these years. And so for PayPal, it's a business that is declining in growth and facing competition as well. So for PayPal, it's in a win-lose business model. PayPal's only ability to grow its income is by increasing its charges or by increasing the global payment volume or the total payment volume. But the problem is they charge 1% on withdrawals and then they charge 3% for international transfers and your wire transfers as well. Whereas you have your other competitors like Wise, Stripe, all of them, they charge a lot lower in terms of the fees as compared to PayPal. So for PayPal, this is their market share. So the market share has been declining for the past few years or so. PayPal is currently having 32% of the market share in your payment processing industry, and you have other competitors coming up as well. You have Stripe with 20%, Adyen with 12%, Shopify with 12%, Amazon Pay 5%, Square with 5%, and so on as well. And then you have some other smaller companies as well like Wise, Fiserv, all competing in this space. So this is the story for PayPal. The company is struggling with competition, and the story right now is their buybacks. I love buybacks, but I want companies with strong moats on top of the buybacks that they have. So I want the company's underlying business to be strong, to be facing very little competition, and for them to add on to that with buybacks. I don't want the entire story of the business to just be buybacks. So for PayPal, you can get a 7% buyback yield and a 5% revenue growth. That will give you around a 12 to 13% EPS growth for PayPal. But I want more organic growth. So for PayPal, I think this is an avoid for me today. I don't think I'll be investing into this one simply because the company is facing too much competition. I think the better bet is simply just to buy Visa or MasterCard when they're reasonably priced. Next stock to avoid is Nike. So Nike year to date, similar to PayPal, is down around 20%. And currently the stock is trading at 20 times earnings. At its 52-week low, it was trading at $52 a share. So for Nike over here, the company is simply facing too much competition. So this is Nike's market share, and as you can see, the Nike's market share has been declining, whereas all your other competitors are increasing in terms of its market share over here. So you have On, you have Asics, you have Hoka, all of them gaining market share from primarily Nike. And for Nike, it's simply just a company that is facing too much headwinds and too much competition at the same time. So competition leads to erosion. Competition is for losers. More competition leads to sharing of profits, and companies will often compete on price to gain more market share in a competitive space. So Nike is a strong brand, but brand value alone is one of the weakest moats out there. And for Nike, it's a company that only has brand value. It doesn't have a differentiated product. It doesn't have any sort of barriers to entry in this footwear industry over here. So for Nike, this is their earnings report from last quarter. So Nike's revenue went down 9%, brand revenue down 9%, direct revenue down 12%, wholesale revenue down 7%. Basically everything in this point was down. Even their margins decreased as well by 3.3% to around 41.5%. And then the SG&A went down by 8%. So although the SG&A is coming down, the revenue is outpacing the reduction in SG&A costs, and that is the problem with the business. When you see that happening, when they're cutting costs at a lower rate as compared to the revenue decline, that is when you see your earnings getting hit, and that is what Nike is experiencing this year as well. So for Nike, the analysts are expecting this year to be a down year, down around 20%. And for them to have a rebound next year, for Nike, it's a long-term turnaround play. If you're willing to bet on the brand, then this could be a worthy investment. But for me, I think I'll be avoiding this one. So for Nike, it's a legacy brand. I love their products, but there's a multitude of problems for retail companies. They have consumer risk, meaning to say when consumer confidence comes down, then your retail stocks, they'll typically be hit the fastest. You're seeing that with Target now. Target reported their earnings just last week, and Target's earnings were not very good. It clearly shows that your discretionary spending is coming down. And then the other headwind for all these different businesses over here is your tariffs as well as competition. So retail is normally an avoid for me. It's not an industry that is extremely high quality, and the competition in that space is simply too much. Next stock is Evolution Gaming. So Evolution Gaming is a very talked about stock, It is a stock that is trading at 10 times earnings, yielding around 5% in terms of dividends. So for Evolution Gaming, the stock dropped because the growth slowed. So not only did the growth slow, the EBITDA margin also came down. So this was the first time in Evolution Gaming's history where the EBITDA margin actually dropped, and you're also seeing some form of decline in growth as well for revenue. So this is Evolution Gaming's main risk. So 40% of their revenue come from Asia, of which 65% is unregulated. So if governments start to crack down, this is a risk for the stock. The European government is already cracking them down. So over here, the Gambling Commission has launched an investigation into supplier Evolution Gaming for suspected black market activity, which could potentially place the company's UK license under review. More specifically, the review has been initiated following the Commission's identification that Evolution Gaming's portfolio is in fact currently accessible via several unlicensed operators in British shops. So Evolution Gaming is facing headwinds in terms of regulation because a lot of the sites that they operate on is unregulated, and that is the problem for this business. So for Evolution Gaming, the stock is extremely cheap, but I hate the industry and the unregulated nature of the business. It is operating in a grey area, and removing those portions will kill the growth. The price is great, but I don't like turnarounds, and that's why it's an avoid for me. And I don't really like investing in vice companies as well because it's a win-lose business model. Over the long term, all these businesses, they will eventually fall. Next portion over here, I'll be talking about some of the earnings that will be happening next week. So the most notable ones will be on Wednesday. After market close, it will be Nvidia as well as Salesforce. So for Nvidia, the company is now down around 5% year to date. At one point, it was down around 40% year to date, so it was quite a retracement from the lows. Currently, the stock is trading at a 44 times earnings and a $3.2 trillion market cap. So for Nvidia, here are some of the headwinds. The stock has a wall of expectation placed on it already, and any flaw in the earnings itself will cause the stock to tank. So if you were to look at their latest earnings from last quarter, the earnings were actually quite remarkable. It was quite amazing. They beat on every single metric, and then the stock dropped because of that. Why? Because the company has so much expectation baked into it already. Every single piece of good news is already priced in. And unless Nvidia produces another 100% quarter again, it is unlikely that the stock will move upwards. So the company has been facing export controls, which will likely hurt their Q1 earnings as well. So in Q1, Trump basically imposed export controls on your H20 chips, and that will lead to around $15 billion in sales reduction for Nvidia. And then SMCI experienced weaker demand as well, which could signal a weakening in AI hardware demand as well. As for the tailwinds for Nvidia chip demand will probably still be strong. They will likely still beat earnings. AMD reported decent earnings as well. TSMC also reported decent earnings. And you have the AI capex spend, which is still strong. And all the CEOs, they came out and reaffirmed that capex guidance, and they will still be spending the amounts that they projected at the start of this year. So this likely means that Nvidia will make a lot of money from all this capex spending as well. Next company is Salesforce. So Salesforce is a company that is down 17% year to date. It's a company that's trading at 42 times earnings. So for Salesforce, the problem with the business is this: the revenue is slowing to single digits, the company's core business is slowing down, and the only way for them to embark on this AI train is through Agentforce. The markets will be focused on Mark Benioff's commentary on just Agentforce. I don't think they'll be so concerned with the numbers unless the revenue growth slows significantly. So for Salesforce over here, on top of the headwinds discussed earlier, this company is also trading at a relatively high valuation. It is currently trading at a 42 times earnings. Although it's at one of its lowest point in its history, it is still a relatively high valuation for any company. So could CRM be replaced by an AI agent in the future? I think that's extremely possible. So Salesforce's only story in this game is for them to create Agentforce. So Salesforce may be a loser in AI, and unless they can successfully embark on this Agentforce project that they have, this company could be hurt by AI in the future, similar to Google search. So for Salesforce, they're currently still the leader in your CRM sector, but the problem with your CRM sector and any single software business is simply just the fragmentation itself. So there's no clear winner in this space. All your different CRMs, they make up very tiny portions of the entire CRM market share, and that's what I don't like about investing in software companies like Salesforce. Unless they have a very dominant moat, unless they have very dominant market share, I don't think investing into Salesforce, especially when an industry is so fragmented like this, is a very good idea. Last portion over here, I'll be talking about some of the questions that you guys have left me in the comment section below. So the first one over here, it says, what do you think of other market index providers than MSCI, such as S&P Global, CME Group, Deutsche Börse, and London Stock Exchange? So S&P Global, I hold a company as well. S&P Global is a quality business, one of the widest moat companies out there. I don't think it will ever be replaceable by any sort of company. The ratings business is high quality. The indices business is high quality as well. The software business is alright. It will grow around 5 to 7% with acquisitions or so. So this company will just compound and compound all this year. So S&P Global for me is a high quality business. So for CME Group, if you don't know what they do in terms of your indices, they have your ES mini futures. And for CME Group over here, they actually pay a licensing fee to S&P Global. So comparing S&P Global and CME Group, I think S&P Global is the better business, and S&P Global is less concentrated in your indices portion as compared to CME Group. As for Deutsche Börse, I'm not too sure what that company does. And for London Stock Exchange, the company is simply just trading at too high a valuation for me to invest into it. So next question over here, it says, "Hey Conrad, nice video, I really enjoyed it. I would like to hear your opinion on portfolio allocation, specifically when and how you decide to trim a position. Do you trim your positions when the stock valuation surpasses its fair value? If so, how much above the fair value do you start trimming? How much do you decide to trim? What is puzzling to me is, if the company can still continue to grow and compound its earnings, what if you've trimmed the position? Wouldn't you be cutting yourself from further upside? And last question, do you have a max allocation for a position in your portfolio? For example, any position cannot be above 20% or so." I know that this is a very long question and I would appreciate if you answered it. Thanks for reading. So a few questions over here. Do you trim your positions when the stock valuation surpasses its fair value? Typically, I don't like doing that. I believe that compounders, high quality compounders, they'll be able to grow into their valuation. So for example, MasterCard, Visa, these two companies, they have never gone below a 25 times earnings simply because the company is so high quality that people will pay a premium for it. So I think for quality businesses, it is worth paying a premium for it. As for whether or not I will trim when it surpasses fair value, typically I don't like doing that. As for cutting yourself from further upside, when I typically decide to sell is when I find a better opportunity to deploy the cash. So for example, if let's say MasterCard is trading at a 40 times earnings, that is growing at 13% or so, and if I can find a better alternative to MasterCard with similar quality and with a lower valuation, then that is when I will swap my position. So yes, I could potentially cut myself from further upside in MasterCard, but if I'm confident that I'll be getting more upside from this other company over here, then that is when I'll sell the stock. Typically, I don't like selling my positions. I only sell if I think the risk is too high in the stock or if the fundamentals start to turn. That will normally be the two reasons for you to sell a stock. The next portion over here is about allocation. So the question is, do you have a max allocation for a position in your portfolio? So there are a few super investors that I follow, Lilu, Dev Kantesaria, Chris Hone. All of them, they have extremely concentrated portfolios. So Dev Kantesaria, for example, he has around 32% of his portfolio in FICO. Lilu has around 37% of his portfolio in Google. Chris Hone has around 18% or so in Microsoft itself. So for myself, I like concentration, but I don't like extreme concentration. So I find Dev Kantesary's approach being too aggressive. I'm sure the FICO position grew to that size. He didn't add the 32% at the start. But typically for me, I like to keep my allocation below 15% for any given stock. I don't like my positions to go to 15 plus percent, 20%, unless the company is so compelling that there's basically nothing that is going to replace or destroy the moat for the company. So for myself, my risk tolerance is not that high. I don't like taking on too much risk, and so 15% is normally the safe area for me when there's a high conviction stock that I'm looking to bet into. I hope you guys have found this one useful and invest safe.